Good evening, everyone, and welcome to another edition of Office Hours. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining us tonight for our February 23rd edition of Office Hours. So with that being said, I want to go ahead and tell you a bit about the center and about office hours before we dig into our topics for the evening, as well as our questions from the community. So just a quick review of the agenda. We'll go through a bit about the center, a bit about office hours, some questions that we've received through social media and email. Then our featured topics for tonight, which will be loan consolidation and public service loan forgiveness, especially the limited PSLF waiver, because it is extremely popular and has been for the past couple of months. Then we'll take a look at a few frequently asked questions and also reserve some additional time for Q&A. So let's get started. A bit about the Maryland Center for Collegiate Financial Wellness. We were founded in the summer of 2021, and we are building financial life skills and empowering students to thrive. We have an ambitious vision for all college and career students in the state of Maryland. And of course, we would like to see this vision spread beyond our state and across the nation. It's that our students are equipped with 6 pillars of financial wellness. The first is to be creditworthy. The second is to be ready, prepared for their classes. Third is resilient in case of an emergency. Fourth is empowered. Fifth is successful, and sixth is thriving. So again, ambitious vision. If you'd like to learn more about it, you can visit the center online at mccfw.org to learn more about the vision, the mission, and the work that we're doing to execute both. About office hours. Office hours is a free semi-monthly virtual student loan clinic that provides borrowers with, again, a free and trusted venue to help them navigate student loans and prepare for financial success beyond repayment. We focus on student loans and office hours, but I hope that everyone knows that we don't just want to prepare people to reach the zero balance. Student loans are a part of life, and we want to help you live with the student loans instead of building your life around them. Before we get into the content and the questions, I do have to say that office hours is for informational purposes only. We do our best to provide you with accurate, up-to-date information. We usually go straight to the source when we're dealing with loans. So much of our information comes from the Department of Education and their Office of Federal Student Aid. But the information that you hear tonight should not be construed as investment advice or legal advice. It's informational purposes only. And we will provide you with plenty of sources so that you can do additional research and hopefully arrive at the best decision for you, your finances, and your household. Now that that's out of the way, I would like to talk a bit about a student loan story. This is a story from a borrower that reached out to me for help in developing a plan to repay student loans. And the situation that I observed from the borrower's credit report was just so alarming that on February the 15th, I just could not hold it in. And I took to Twitter and I posted the following. It said, helping a borrower who owes $100,000 on a private student loan for an undergraduate degree. The borrower had trouble repaying the loan due to being underemployed. The lender wanted $500 per month. This was an unusual debt load for an in-state student, so I asked for their credit report, and the original loan was listed at $6,000. And with the hand claps for extra emphasis, I just made a statement, not a question, but truly a statement. How is this legal? How can a debt grow from $6,000 to $100,000? I had no idea that by venting a little bit on Twitter that this particular tweet would end up making 4 million impressions, close to 300,000 engagements, and just a lot of mentions. So I've received a lot of feedback on this tweet. A lot of people want to know what are the details, and I do too. And I went back and added to the original tweet to say that once I have the details on the loan, I will share, because it's important for us to know how situations like this come about so that we can avoid them. I don't have the details on the original loan yet, but as soon as I do have the details on that loan, I will share them, because I, again, think it's important for us to see how situations can spiral to a place like this. I have not seen a debt like this before, but this was what I saw on a credit report. I shared it, and in addition to people questioning whether or not I read the credit report correctly or what the borrower must have done wrong. Many other people chimed in and shared their own student loan stories with federal student loans and private student loans, especially around how their balances went from something relatively small to something relatively large and unaffordable. So while this particular example, the numbers are unusual, there are plenty of people out there who are experiencing similar issues, having to be responsible for far more than they borrowed and looking for a strategy to help get the student loan situation under control. So I will definitely report back when I have those original loan documents, because me and a whole bunch of other people are wondering how the number got to that place. But more importantly, I want to help people come up with strategies to manage this type of debt and get it under control. So surprise, surprise. This is one of the comments that I received in response to that particular tweet. It says, and it's not actually a question here, it was just a comment. It says, I have $100,000 in private student loan debt from a credit union with a massive interest rate. I pay $665 per month, which is more than my rent, in repayment. I've made payments on time for years and have a steady job, but I can't afford anything because of it. I know that this was not posed as a question, but I do want to give just a little bit of insight for people who might be dealing with similar issues. It depends on what types of loans you have. Federal student loans have benefits that are not available to private student loan holders. With federal student loans, if you find that your payment is unaffordable and you're on one of the fixed plans, you should reach out to your servicer and inquire about an income-driven repayment plan. The income-driven repayment plan may give you a payment that's more affordable because it's based on your household characteristics, including your adjusted gross income, how many dependents you have, and how you file your taxes. So the payment is more affordable because it's built around your household finances. The potential drawback of an income-driven plan is that sometimes, depending on your household finances, your monthly payment that's calculated could be so low that it doesn't cover the interest that's accruing each month. And if that's the case, you're going to keep on making payments, but you're going to see your balance continue to rise because each monthly payment is not covering the interest that's accruing on the loan. A benefit that income-driven plans have is that borrowers can have their remaining debt forgiven after 20 or 25 years of repayment through those plans, depending on what type of income-driven plan they're in. For those of you who are familiar with income-driven plans and may have been paying under one for a long time, I'm sure you've heard some of the news about how the forgiveness aspect of those income-driven plans has not necessarily come to fruition for many borrowers. The good thing to know is that the Biden administration has expressed interest in righting that situation. One of the things that was implemented was a temporary pause on the so-called tax bomb that would have people who've had their debt forgiven through income-driven repayment plans be taxed on that forgiven amount at the level of ordinary income. So that tax bomb has been temporarily paused through the end of 2025, and hopefully we will see some more movement from the Department of Education and the Office of Federal Student Aid to make sure that borrowers who enroll in these income-driven plans are able to access the forgiveness that has been stated as available to them. For those of you that have private student loan debt, unfortunately, the federal protections and benefits do not apply. So you have to really rely on your lender working with you. If you're experiencing financial hardship, you want to reach out to the lender and let them know what's going on and see if there's any way that you might be able to negotiate a lower payment. Perhaps take a brief pause until you get your finances into more of a manageable situation. But really, you have to deal with the lender because private lenders are not subject to the same rules as the federal government is as a lender. So I'm sorry that the situation is so difficult for many people, but make sure that you reach out to the lender to attempt to negotiate. And if you do feel that you have reached an impasse or you feel that the service that you have been provided with has not given you a resolution that's helpful or desirable, I encourage you to advocate for yourself further by complaining to the Consumer Financial Protection Bureau. You can visit them online at consumerfinance.gov, and perhaps reaching out to them might help you obtain a resolution that's more reasonable for your finances. All right. So here we have a question. This question was, I had $130,000 in loans after graduating from law school in 2006. Today, thanks in part to some inheritance money, I'm down to approximately $73,000. Considering liquidating an IRA that contains money from past jobs to pay off the rest. So this person is thinking about tapping into their individual retirement account to liquidate the funds that are there and use that money to pay off the remaining $73,000 in student loan debt. I have to say from the outset that this goes beyond the level of counsel that we typically provide during office hours. So I cannot give you, financial or legal advice to say, yes, do it, or no, don't do it. What I can do is tell you that there are several things that you should consider. The first thing I'd like to suggest is considering any fees that you might be charged for early withdrawal on the from the IRA account. If there are penalties, I believe penalties are waived through the CARES Act for some time. But again, you'd have to research that and see if the penalties still apply, because those penalties will be taken off of the funds before the funds reach you and in turn get paid to your lender. So fees for number one. Number two, I would consider what your plans are in the future for your retirement. So if you take the funds from your retirement account and use those funds to pay back the student loans, what are your plans, or do you have any plans to replenish your retirement account? And if you do have plans, if you'd like to see that retirement account restored completely, do you believe that you have the discipline to take the money, periodically and build that retirement account back up to where it was, so that when you want to retire, you are able to retire? The other thing that I would hold also, not as something to rely upon fully, but just think about the conversation that's happening around student loan debt cancellation. If you were to liquidate your retirement account and pay down your student loan debt, and then a benefit does happen to come from the federal government that includes large scale cancellation. I'm not saying full cancellation, but if there's cancellation that applies to everyone, and let's say it's $10,000, $20,000, $50,000 per person, if you've liquidated your retirement account to pay for that, then it's possible that you miss out on that benefit. That, again, is something that I would not put a lot of stock in, but just remember that relief for student loan borrowers is a possibility. And if you use your retirement funds to pay off your student loan debt, then you would have no debt to receive that benefit. The other thing that I would consider is also timing. Right now, the market has been kind of rough. I haven't checked the figures on today, but I know that there are some global conditions that are causing a lot of concern and causing financial markets to drift downward. So when you think about withdrawing from a retirement account or withdrawing from any type of investment account, you want to consider what you stand to lose by withdrawing at a certain point in time. Some people suggest that you buy low and sell high. If it's an emergency, you get out when you can. But these are things that you want to consider when you're pulling out investments in order to pay for student loan debt. The last thing that I would think about is interest rates. What's the interest rate on your debt? And what is the interest rate that you've been earning through that IRA over the years? Compare those interest rates. See if it's worth pulling out and foregoing potential gains in order to pay down that debt. All of this to say, again, I cannot tell you yay or nay. It is a truly personal decision, but I do think that the things you should consider are taxes, fees, the value of those investments, and your future plans for retirement, and whether you can replenish the retirement account so that you can still retire on time if you do indeed liquidate it in order to pay for that student loan debt. So all over the place, but I hope that those considerations will help you make a solid decision for you and your household. All right. Next question that came through. This one is much easier. It's any risk to consolidating my loans before applying for the public service option. So by the public service option, this borrower is referring to public service loan forgiveness. And right now we are in the midst of the limited PSLF waiver, which is temporarily expanded eligibility for public service loan forgiveness. For some borrowers who would have been completely shut out of this program prior to October of last year, consolidating can actually be the gateway for them to gain eligibility for public service loan forgiveness. So the answer is consolidating before you apply for public service loan forgiveness can actually make for a smoother application process. But because this question has multiple layers, we've got consolidation and we've got public service loan forgiveness, I wanted to take a bit of time to do kind of a deep dive into what consolidation means, and then we'll get into public service loan forgiveness as well. For those of you who are just joining, if you welcome, first of all, to Office Hours presented by the Maryland Center for Collegiate Financial Wellness. If you have questions, I'm going to take many of them at the end after answering several during this presentation. But if you have questions, feel free to drop those in the Q&A, and I will check those from time to time to make sure that I am indeed answering your questions. All right, back to the question at hand, which is about consolidation. Let's explore what consolidation actually means. So what is consolidation? Consolidation is the process of combining two or more existing loans into one new loan. Some reasons that people might consider before consolidating include, number one, it can help you keep your records more easily. If you have, let's say, 6 loans, and those 6 loans are held by 6 different servicers, then that means you have to make 6 payments each month. By consolidating, those 6 loans will become one new loan, and you then have one bill, one servicer, one point of contact for all things related to your student loans. The second issue, and this one is more relevant to the question that was posed, is that consolidation can help some people gain eligibility for public service loan forgiveness. I'll also say that there's some circumstances where you don't have to have 2 loans in order to consolidate. You can have one. And if that one loan happens to be an FFEL loan or a Perkins loan, that could be consolidated into the direct loan program. And that's how the older loans gain eligibility for public service loan forgiveness. So the image that you see here about consolidation, this just shows you 2 loans being combined to make a new one. If we have a first loan at $30,000 and a second loan at $40,000, if you decide to consolidate those loans, the original 2 loans will be paid off, and one new loan will be originated for the total value of those older 2 loans. So 30 over here and 40 over there becomes 70 together in your new consolidated loan. I do want to point out, though, that federal student loan consolidation and private loan refinancing are 2 different things. Sometimes people refer to consolidation as a refinance and a refi as consolidation, but these have very different meanings when it comes to student loans. And we'll talk a bit more about that difference in the next couple of slides. So, questions to consider about consolidation. The first question is, what types of loans do you have? If you have federal student loans, then you might have FFEL loans, Perkins loans, direct loans of the subsidized, unsubsidized, or even plus variety. You could have lots of different types of loans. If you're interested in public service loan forgiveness, then the only time you would have to consolidate would be if you have FFEL loans, Perkins loans, loans that are not direct, because direct loans are eligible for public service loan forgiveness. So if you have those older types of loans, you're interested in pursuing public service loan forgiveness, then it's one of those things that you pretty much have to do if you want to gain eligibility for public service loan forgiveness. And that answers question number 2. If you are pursuing public service loan forgiveness, your loans need to be direct loans. If you have loans that are not direct, you could consolidate them into the direct loan program, and that direct consolidation loan would then become eligible for public service loan forgiveness. A third question to consider: how many lenders and servicers do you have? If you have federal student loans, then you should have one lender. That's the Department of Education. But it's quite possible that you have several servicers, especially if you went to school many years ago, or if you have multiple degrees or multiple stints in school. So if you have several servicers and record keeping is not your strong suit, then consolidation could be a way to improve the situation so that you'd only have one lender. Well, you've had one lender before, but you'd only have one servicer and one point of contact and one payment to make each month. The next question, though, how long have you been in repayment? For those of you who are interested in pursuing public service loan forgiveness and you have the older non-direct loans, this question might not be as much of an issue, but if you have direct loans and let's say you're not interested in public service loan forgiveness, but you're thinking about consolidation, I really want you to think about your overall repayment timeline, because when you consolidate student loans, your old loans are paid off. A new loan is originated. And if a new loan is originated, that means that your repayment clock is restarting because this is a new loan. So as an example, if you had $100,000 worth of loans that you have been repaying for 8 years, and you decide that you're thinking about consolidating, if you consolidate those loans, you're not starting from 8 years, you're starting from payment one, day one. So you have a new repayment term for that consolidation loan. And repayment terms on federal student loans can range from 10 to 25 years. And for consolidation loans, that can go up to 30 years. So you really want to think about if you completely want to reset that clock on repayment. If you're interested in public service loan forgiveness, and again, you have those older FFEL loans, Perkins loans, then you need to consolidate in order to gain eligibility for public service loan forgiveness. If you're not on the public service track, please pay attention to that timeline question and think about how long you've been in repayment. The last question is, with private loans specifically, will refinancing save you money through a change in interest rates? With federal student loans, refinancing is not an option. Consolidation is. With private student loans, usually people consider refinancing federal loans into private loans because they're looking for a break or a better interest rate. You could end up realizing a better interest rate, but you also stand to lose benefits like eligibility for public service loan forgiveness. So in this example with the image, we have the two loans. One loan for $30,000 at 4%, the second loan at $40,000 for 5%. If you refinance those loans through a private lender, it's going to be $70,000 at, we don't know what the rate will be because the private lenders will run whatever their formula is and evaluate your application and assign an interest rate. With federal student loans, because refinancing is not an option, the interest rate on your consolidation loan is just going to be the weighted average of the individual rates on your older loans. So remember, big difference between consolidating federal student loans and refinancing private student loans. I'm going to pause for just a moment here because I see I've got a question in the Q&A and I want to get to it. Pardon the mouse. Okay. All right. I've got a question here. It says, I heard a rumor that private loans can be consolidated into direct loans and that those will be taken up by the feds. True or not true? You know, I have not heard that rumor. Usually you can go, as far as I know, you can go from federal to private, but you cannot go from private to federal. The next slide actually talks about what happens when you go from federal to private. So let me scoot on over there. Give me one moment. Pardon my wayward mouse. Okay. All right, let's talk a bit about the federal to private. What happens when you go from federal to private, you are refinancing. The federal government does not offer refinancing. So if your primary concern is looking for a better interest rate, then the federal government is not the place to look. You will not get an interest rate break by consolidating your federal student loans. Private lenders have more flexibility with the interest rate, so you may get a better interest rate. However, if you refinance your loans with a private lender, you'll lose eligibility for federal benefits, such as access to the income-driven repayment plans, discharge in the event of total or permanent disability, and also access to public service loan forgiveness. Your loans will no longer be eligible for public service loan forgiveness. So the decision to take federal loans and refinance them with a private lender is something that you don't want to enter into lightly. If you know that a career in public service is not in the cards for you and your primary concern is an interest rate, maybe paying down the debt aggressively and trying to look for the lowest interest rate possible, then a private lender, a refinance through a private lender could be something that you want to explore. But just be mindful that if you refinance into a private student loan, you will lose all the benefits that are available to federal student loan borrowers. So let's take a step back and look at consolidation of federal student loans. If your loans are not direct loans, again, you will need to consolidate them in order to pursue public service loan forgiveness. FFVL loans and Perkins loans are not eligible for public service loan forgiveness, but if you consolidate them into a direct consolidation loan, then they can become eligible through that consolidation. So if you need to consolidate, you can complete the application for consolidation online at studentaid.gov. And when you complete the application, make sure to indicate that you are interested in public service loan forgiveness. Once you indicate that you plan to pursue public service loan forgiveness, your loans will be moved over to the Department of Education's designated servicer for the PSLF program. So if your loans are not already with that company, the current company is Fed Loan Servicing. If your loans are currently not serviced by Fed Loan Servicing, and you decide that you're going to pursue PSLF, your loans will be transferred to Fed Loan, and Fed Loan will become your new servicer. I have a recommendation here for a smoother process for those of you who are applying for PSLF through the limited waiver. If you consolidate your loans first and wait until the consolidation loan has been dispersed, it can make for a smoother process when you submit the actual application for PSLF. The application for PSLF can be used to apply for forgiveness if you think that you're eligible right now, but it can also be something that you complete to verify your employment so that the Department of Education and its servicer will know to start counting how many months you have toward the 120 that are necessary for public service loan forgiveness, okay? So I hope that the explanation of consolidating federal student loans versus refinancing with a private lender was clear. If you all have any questions, please do let me know. I'm gonna check the Q&A one more time just to see if I've got any questions out there. Nope. All right, that question is done. Let's get back to the slides. All right, give me one moment. This mouse is all over the place. Okay, so with that being said, public service loan forgiveness is by far the most popular topic amongst people in our circles right now. So I wanted to take some time to explain how public service loan forgiveness works in its original form and what makes this waiver so different and such a life-changing opportunity for many members of our community. So the graphic that you see here is straight from the Department of Education's Office of Federal Student Aid, and this gives you the 5 requirements of how to qualify for public service loan forgiveness under the original rules. The first requirement is you have to make 120 qualifying payments. Those payments have to be made on direct loans only. So that's the second requirement. You can only have direct loans. The third requirement is that the payments have to be made while you're enrolled in a qualifying repayment plan. The fourth requirement is that the first 3 requirements have to take place while you're working for a qualifying employer. And the fifth requirement is you still have to be working for that qualifying employer at the time that you apply for PSLF and at the time that you receive PSLF. And as per the IRS, the forgiven amount is not taxable income at the federal level. So those are the 5 requirements. They all have to work in order for you to be approved for public service loan forgiveness. So let's go through each one of those qualifications in a bit more detail. The first one is qualifying payments. You have to make a minimum of 120 monthly payments. So basically this means you're in it for a minimum of 10 years. Those payments must have been made after October 1st of 2007. The payments must be on time and in full. If you made multiple partial payments in 1 month, they'll count as one payment, and all payments must be received within 15 days of the due date. One popular misconception about public service loan forgiveness in these 120 payments is that the payments have to be consecutive. That means that you'd have to go payment 1 through 120 without missing a beat. That's not true. The payments don't have to be consecutive. If you switch jobs and took a break in between, it's okay. The payments while you were on the break would not count, but you would not lose credit for the payments that you made prior to the break. So there can be gaps in payment. It's just that the program will work for you faster if those payments are indeed consecutive. Also, extra payments do not qualify. You can't make 3 payments in 1 month and get forgiveness 3 months faster. You're looking at a minimum of 120 monthly payments. Also, another question that usually comes along with this is, what about the months during the CARES Act forbearance where we haven't been required to make payments, interest has not been accruing? Do those months count toward public service loan forgiveness? Well, the months of 0 should count toward public service loan forgiveness if you satisfy the employment qualification. So as long as you are working in public service full-time and your loans are in a repayment status, then those months during the CARES Act forbearance should count toward the 120 necessary for public service loan forgiveness. All right, requirement number 2 is that the PSLF only applies to direct loans. There's several varieties of direct loans. There's direct subsidized loans, direct unsubsidized loans, direct plus loans for graduate and professional students, as well as direct parent plus loans and direct consolidation loans. If you have a bunch of these loans that are direct, as long as they're direct loans are eligible for public service loan forgiveness. But if you wanted to consolidate them just so that you'd have one big one instead of lots of separate ones, again, you could complete that application online by logging into studentaid.gov. The application is online, it's free, and you can complete it by yourself. All right, requirement number 3 is that the payments that you make toward public service loan forgiveness have to be made while you are enrolled in a qualifying repayment plan. The list of qualifying repayment plans includes the 10-year standard plan, all of the income-driven plans, income-based repayment, income contingent repayment, pay-as-you-earn, and revised pay-as-you-earn. Also, any other plans for which the monthly payment is greater than the 10-year standard plan payment. That's rare. So just focus on the income-driven payment plans as well as the 10-year standard plan. Usually when people see this slide, they say, well, why would the 10-year standard plan matter? If I pay them off in 10 years, I'll have nothing left to forgive. That's true. But for some people who pay under the income-driven plans, it's possible that later in their careers, usually when they get closer to the latter years of repayment, their income could be so high that the payment that's calculated under an income-driven plan is higher than the payment that's made under the 10-year standard plan. If that's the case, they might choose to go into the standard plan and pay the lower amount until they reach the 120 months necessary for public service loan forgiveness. So if your plan is to start and finish on a 10-year standard plan, then public service loan forgiveness is not something that you're pursuing because your balance will be paid off in 10 years. But if you start on an income-driven plan and you come into some money later on and it drives up what your payment would be under one of those income-driven plans, then you may find that the 10-year standard plan is more affordable. I do have to say, though, that the income-driven plans are the ones that are most likely to yield a balance for forgiveness. So if you pay under one of those income-driven plans, that's the road that's most likely going to leave you a balance to have forgiven after you've satisfied that 120-month requirement. A quick note about Parent Plus loans. ICR, which is income contingent repayment, is the only income-driven repayment plan that's available to parents who are repaying Parent Plus loans. So if you're a parent, you have Plus loans, and you're interested in PSLF in an income-driven plan, then ICR would be the plan for you because it's the only one that's available to Parent Plus borrowers. All right, requirement number 4. This is a big one, qualifying employment. I want you to just leave with this. Where you work matters more than what you do. It is the employer, not your specific role within the organization, that determines whether your employment qualifies for public service loan forgiveness. So qualifying employers include government. This could be federal, state, local, even tribal levels of government are recognized as public service employers. Also, 501c3 tax-exempt organizations are qualifying employers. There are some other not-for-profit organizations that are tax-exempt, but not under 501c3. And those organizations might be eligible employers for public service loan forgiveness as well, as long as they provide qualifying services. Also, you have to be employed full-time. Full-time is the greater of your employer's definition of full-time or 30 hours per week. If you have more than one part-time job, it is possible to combine those part-time jobs into full-time employment for the purposes of applying for public service loan forgiveness. So multiple jobs are okay, but they need to be combined to gain access to public service loan forgiveness. Quick note that is particularly helpful for members of the clergy. Prior to July 1st of 2021, for borrowers who worked at nonprofit organizations, any hours that they spent engaged in religious instruction, worship services, or proselytizing did not count toward public service loan forgiveness. So for a member of the clergy, they might have to look at all the hours that they spend on average in a week and draw the line between the religious, the hours that might have been spent in religious activities versus activities that were services to the public, and only count the hours that were service to the public in their application for public service loan forgiveness. But that restriction was eliminated as of July 1st of 2021. So no more separating those hours. All right, our final requirement is that borrowers must work in a public service career at the time that they submit the application for public service loan forgiveness and at the time that loan forgiveness is received. This is one requirement where I've seen many people lose the eligibility for public service loan forgiveness. They had 10 years worth of loans in repayment. They had 10 years worth of public service employment, but they did not learn about the program until they had left their public service career and didn't apply for it on time. So with all of those qualifications having to work together in tandem, it should not be surprising that 98% of the borrowers who applied for public service loan forgiveness have been rejected. The government actually created another program called Temporary Expanded Public Service Loan Forgiveness that counted payments that were made under ineligible repayment plans. All the other requirements remained intact. That program, unfortunately, had a similar rejection rate. So between 2018 and 2021, approximately 16,000 borrowers had their applications approved for public service loan forgiveness out of the about, I think, 1.3 million who applied. There was a change implemented to the public service loan forgiveness program in October. It's called the Limited PSLF Waiver. In the 3 months since the waiver was implemented, that number has increased to 70,000, okay? So it took 3 years for 16,000 people to gain forgiveness. And during the past 3 months, we've had 54,000 people gain approval for public service loan forgiveness. Those numbers alone tell you that this waiver has truly changed a lot of lives. So let's talk about the waiver and what makes it so different from the original form of public service loan forgiveness and the temporary expanded version of public service loan forgiveness. So looking at the far left column, these are the requirements for original public service loan forgiveness. You've got 120 monthly payments. Payments can only be made on direct loans only. You have to be enrolled in a qualifying repayment plan the entire time. You have to be working for a qualifying employer. You have to remain working with a qualified employer at the time that you apply for PSLF and at the time that you receive PSLF. Let's move to the middle. We have temporary expanded public service loan forgiveness. Still 120 monthly payments, still on direct loans only, while you're working for a qualifying employer, and you must remain working for that for one qualifying employer at the time that you apply for PSLF and receive it. The only qualification that was eliminated was the restriction on repayment plans. If we look to the far right in that limited PSLF waiver, we see that there are now only 2 requirements for the program. The first requirement is that the borrower has to have 120 periods of repayment. Notice the difference in language here. We went from monthly payments to periods of repayment because the Department of Education is not looking at actual payments. They're looking at the status of the loans to see if the loan was in a repayment status. So 120 periods of repayment means 120 months when you had loans that were in a repayment status. It doesn't matter if you made a payment or not. It doesn't matter if your payment was late or if you made multiple payments. They're not looking at the payments. They're looking at the status of the loan. And you need to have 120 months where your loans were in repayment. The only other qualification that remains is that those 120 periods of repayment had to overlap with your work for a qualifying employer. So we went from 5 to 2. The final 2 are 100 periods of repayment while you're working for a qualifying employer. So when you look at this comparison and you see how we went from 5 requirements to 4 requirements to 2 requirements, I think it's easier to explain how we went from 16,000 people being approved in 3 years to 54,000 people being approved over the course of just 3 months since this waiver went into effect. I'm going to take a brief pause and check the Q&A because I see I have a question here. All right. Question about the working full-time status. How does this work for faculty working at colleges and universities? For example, adjuncts working in state schools are not full-time, but they do work more than 30 hours. I asked because I was an adjunct at a state school for 6 years, and it hurts to think that all my years of work won't apply until this year when I got tenure. Okay, so for adjuncts, it really comes down to how your employer measures your time. I've been an adjunct before. My adjunct positions were part-time positions. So what I have seen people do is serve as an adjunct instructor at different colleges and combine those adjunct roles, 2 part-time adjunct roles into 1 full-time role for the purposes of applying for public service loan forgiveness. So what you would have to do is for each college or university where you served as an adjunct, you would complete the PSLF application to verify your employment. And if each position counts as part-time, what I would, and I would say I'd hope for is that these 2 part-time positions will be put together to equate 1 full-time position. So even if they're different colleges or universities, that's okay. If you have 2 part-time opportunities that were happening at the same time, we combine those into 1 full-time position. So when you look at the PSLF application, there are a couple of things there. One question is, what's your status, full-time or part-time? The other is how many hours on average you work per week. So whoever is going to verify your employment will have to answer the question, what's your status, full-time or part-time, and how many hours do you work per week? What I would like to see for you as an adjunct, if you were full-time but in an adjunct capacity, then that line is pretty clear, you're full-time. But if you have multiple part-time adjunct positions, fill out the paperwork for both part-time positions. And if they took place at the same time, then combine those 2 part-time roles to be 1 full-time role. I saw another question pop up, so I'm going to answer that as well. All right. The next question is, I've had periods that my federal loans were in forbearance. Would that qualify for PSLF under the waiver? Unfortunately, a forbearance does not count as in repayment status, with the exception of the CARES Act forbearance. The CARES Act forbearance is one that we didn't have any control over. The government extended us this period of not having to make payments and also not having interest accrue on our loans. We didn't choose that. So the months during the CARES Act forbearance should count toward the 120 necessary for public service loan forgiveness. But if you took a pause in payments on your own, then unfortunately a forbearance does not qualify. I will say that there are some people who have mentioned that they were placed into a forbearance by their servicer while they were waiting for their income maybe to be recertified for an income-driven repayment plan. So if you have not submitted the paperwork already, I encourage you to submit the paperwork. Wait to see what the count is that the servicer or the Department of Education comes back with. And if there are any months where you feel as though the status does not reflect what was going on, then dispute it, okay? Because there are some cases where I've seen several people who pull their loan history and it lists their status. And one status that it shows is, under review, or you didn't have a payment due at this time. And the language isn't very clear. But just be mindful, the Department of Education is going to be conducting this particular review on your months of repayment to look at the status of the repayment status of your loan. So they'll make that determination. If you find that there's some type of discrepancy, or there's some months where you were in repayment and that's not accurately reflected in the count, then you go back, you dispute them. Okay. And all right, answer the question about the adjunct opportunities. I hope that I have answered your questions. Please let me know if you need further clarification on those. And again, part-time employment, it's all right if you can combine more than one part-time position for the purposes of public service loan forgiveness. But teaching in general, I have to say that teaching positions always bring about a lot of questions, because people are looking at the 30 hours per week and saying, oh, well, what if I don't work for the summer? The Department of Education, they know how it works for teachers. You might be a 10-month employee, you have 2 months off, but you're still considered a full-time employee. So I can understand why the teaching part definitely creates a bit of uncertainty there around the application process and how those hours are viewed. All right. We've got another question. That is, so if you consolidate your loans, would those prior IBR payments made count, or does the clock start over? All right. So through this limited public service loan forgiveness waiver, those payments will not be wiped out. That is one of the huge benefits of this waiver. If you had applied for public service loan forgiveness under the original rules, you wouldn't get credit for past payments that were made on older loans. And if you consolidated, your repayment clock and your PSLF count would all start back at number 1 with your first payment. This waiver is different in that if you consolidate your loans, the department is going to look back at the repayment status history of the loans that are included in what you're consolidating, and they will give you credit for those past payments. If you have loans that are on different clocks, like you have undergraduate loans, you have graduate school loans, and those loans have been in repayment for different amounts of time, the language that's out there from the Department of Education is that if you combine those loans, they will give you credit on the entire consolidation loan for the loan in the portfolio that has the highest number of payments. So if you have older loans and newer loans, and you put those together, the consolidation loan is supposed to get credit for the number of months attached to the oldest loan, the loan that has the longest repayment history in the portfolio. So the short answer to the question is yes, the prior payments that you made on IBR, as long as you were working in public service at the same time, those past payments will gain credit for public service loan forgiveness through this waiver. Under original PSLF, that was not the case. And that's why many people just thought, well, why should I consolidate? I'm halfway through repayment. If I consolidate, it's going to start the clock again, and I still have 10 years to go. And they just decided not to consolidate. If you're one of those people, please look at this waiver and consider the consolidation. In order to make the process flow a bit easier, I mentioned earlier that if you consolidate your loans first, the loans will be transferred to the servicer that's responsible for public service loan forgiveness, and then submit your application for PSLF. That can help the process move more smoothly, because the transfer of loans from your current servicer to the department's PSLF servicer could take a few weeks. After that consolidation loan has been originated, you submit your paperwork for PSLF, and hopefully they'll be able to give you an updated count faster. Okay. All right. Here we go. Okay, so if we take a look again at this waiver, again, left-hand column shows you original PSLF, 5 requirements, and it's easy to see how 98% of people could get rejected with all of those requirements having to be in place at the same time. Temporary expanded public service loan forgiveness eliminated one of those requirements, but limited PSLF waiver, that's where you see the big change, going from 5 requirements down to 2, not actually looking at your payments, but instead looking at the status of your loans to see if they were in repayment, as well as your work in public service. So quick note here for people who may have retired or may have left the not-for-profit or public service space and gone into a for-profit industry, still consider applying through the waiver, because if you have those 120 periods of repayment while you were working in public service, the application is truly the only thing standing between you and getting your loans forgiven. So if you're not working in public service anymore, please do not let that deter you from applying for this opportunity. All right, here we go. Okay, again, the old versus the new. Under the new temporary rules, any prior payment that's made will count as a qualifying payment, regardless of the loan type, repayment plan, or whether the payment was made on time or in full. This change applies to student loan borrowers who have direct loans, those who have already consolidated into the direct loan program, and those who consolidate into the direct loan program by October 31st of 2022. This is a time-sensitive opportunity. You want to make sure that if you're interested in applying for PSLF through the waiver, you apply by October 31st of 2022. Quick note here about Parent Plus loans. These come up quite a bit. Parent Plus loans alone are not eligible under the limited PSLF waiver. So if you're a parent and all you have borrowed are Parent Plus loans for your child's education, unfortunately, Parent Plus loans are not eligible for evaluation under the waiver. However, if you are a parent who has loans that you borrowed for your child and you have loans that you took out for your own education, you could consolidate those loans, and the department will evaluate your consolidation loan based on the repayment history of the loans you have borrowed for yourself. They will effectively ignore your Parent Plus loans. But if your consolidation loan is forgiven, those Parent Plus loans are forgiven too, because they're a part of your consolidation loan now. So while Parent Plus loans by themselves are not eligible for the waiver, if you are a borrower who has Parent Plus loans for your child and student loans that you borrowed for yourself, then you might want to explore consolidating those loans into a direct consolidation loan and applying for public service loan forgiveness through the waiver. All right. Again, the PSLF limited waiver, it's a time-sensitive opportunity. So there are 3 steps that we at the center recommend that borrowers take. The first one is that you know your federal student loans. You can log into studentaid.gov online at any time and view your federal student loan portfolio. The types of loans you have will dictate your next steps. So the second step is you have a decision point. You have to decide whether to consolidate. If you have FFEL and Perkins loans or non-direct loans, and you want to apply for public service loan forgiveness, then you would have to consolidate those loans into a direct consolidation loan in order to gain eligibility. If you want to do this, you want to make sure that you apply by October 31st of 2022. From everything that I've heard, this is a hard stop. So you don't want to play around and wait on this and be left out. Make sure that you take action by October 31st of 2022. Everyone, regardless of the kind of loans you have, everyone who's interested in applying for public service loan forgiveness, you must certify your employment. Certifying your employment sounds complicated, but it's really just an HR verification. You can use the PSLF Help Tool online at studentaid.gov to begin to fill in the application online. And then you'll need to take it to your employer and have someone verify the information that you've included. What's important for them to verify, of course, is the kind of organization you work for, your start and end date, whether you're full-time or part-time, and the average number of hours you work per week. You can download that application, the paper version of it, also from studentaid.gov. And again, submit the form by October 31st of 2022. Quick review of those steps. Know your loans. Second is, once you've seen the type of loans you have, decide whether consolidation is necessary. Third, this one goes for everyone, regardless of the type of loans you have to certify your employment. If you don't certify your employment, the Department of Education and their PSLF servicer will never know that you're interested in public service loan forgiveness. So make sure that you certify your employment so you can get on the right path to getting that count up to 120. All right, wow, that time flew fast. We've got about 5 minutes left. I want to share with you a few more informational resources. Of course, the first one is studentaid.gov. If you have federal student loans, it's best to go to the source for information about your loans. You can view your loan portfolio, you can access the Public Service Loan Forgiveness Help Tool, and you can also complete the application to consolidate online for free at studentaid.gov. Another thing that you can get for free is free student loan advice from the Institute of Student Loan Advisors. They also have a PSLF mega thread on Reddit. It has plenty of information about PSLF, the original version, as well as the Limited PSLF Waiver. And there you can see real-time information from people who have submitted applications or people who are pondering applying for PSLF, and you can hear about the experiences and the processing times that they are seeing. If you are a Reddit user, please check out the PSLF mega thread. Additionally, the Student Borrower Protection Center online at protectborrowers.org, they have a video library of brief videos that will show you what it looks like to log into studentaid.gov and identify your loans. Also, how to complete the PSLF application for certifying your employment, and also consolidating your loans. So you can visit them online at protectborrowers.org. All right, I don't see any additional questions in the Q&A, so I'm going to breeze through a couple of the questions that we frequently have. This first one is, I began completing the PSLF Help Tool online, and the result from my employer is unsure of eligibility. What does that mean? It doesn't mean that your employer is ineligible for public service loan forgiveness. What it means is that your employer is not in the database that's there. Some employers just aren't listed. I think this happens a lot with churches and other places of worship. They may not have the 501c3 status, but they do qualify as public charities. So this is not a sign that you should abandon your application. This just means that there may be an additional layer of paperwork for you to pursue PSLF. So don't give up. They might not be in the database, but that does not mean that the employer is ineligible. There's just going to be an added layer of work to do. Next question is, I have FFEL, Perkins, and direct loans. Will the waiver count one payment per loan per month or just one payment per month? The answer is the waiver examines months of repayment. You wouldn't get extra credit for having more loans and having to make more payments each month. The waiver is going to look at each loan and examine the months of repayment, but you don't get multiple credit per month for having multiple loans. All right, and our last question, we get this one all the time. How do I know if I qualify? There are two things. Your employment history and your repayment status history are going to determine whether you qualify. You have to certify your employment, or else the Department of Education will never know that you're interested in public service loan forgiveness. And the Department of Education will evaluate your repayment history. But what triggers the review of your repayment history and your employment history is you certifying your employment. And you can complete the application to certify your employment at studentaid.gov. All right. And our next question, what should I do next and when? It depends on the types of loans you have. Everyone has to certify their employment because that's the only way the Department of Education and its PSLF servicer will know that you're interested in public service loan forgiveness and in turn count your months of eligibility. But If you have non-direct loans, you have an extra step. You have to decide whether you want to consolidate to gain eligibility for public service loan forgiveness. If you do decide to consolidate or to apply for PSLF through the waiver, you need to make sure that you do so by October 31st of 2022. All right, so we took questions throughout. I can't believe I've only got 1 minute left. I'm going to check the Q&A one more time. Okay. All right, we've got nothing new in the Q&A. And I don't see anything. I'm going to check socials very quickly. All right. I don't see anything here either, so I'm going to take that as a sign I've answered all the questions you all can come up with during this time we have together. I also want to thank you for those of you that joined me tonight for office hours. Thank you so much for attending. I hope that your questions were answered. If they were not, please do feel free to contact me. We have another office hours coming up on March the 9th and again on March the 23rd. We'll be here on those Wednesday evenings at 7 p.m. In the meantime, you can reach out to the center via social media at the MCCFW, and also visit us online at mccfw.org. Again, I thank you so much for joining us for the February 23rd edition of Office Hours. Please do stay in touch, and I appreciate you being a part of the journey of the Maryland Center for Collegiate Financial Wellness, where we are helping students and families build their financial life skills and empowering them to thrive. Until then, take care. See you next time. Can't log off just yet because I saw another question pop up. It's just a comment. Thank you for a great presentation. You are so welcome. Thank you for that. Thank you very much. And another thank you in the chat. You are so welcome. Thank you all again. And again, reach out in the meantime if you have any additional questions. And I will see you all, or hopefully some more borrowers, at our next edition of Office Hours on March the 9th at 7 p.m. Eastern Time. Take care, for real this time.